your house is perhaps the biggest financial decision that you'll ever make. And this is why it is so important that you do whatever it takes to make sure that your mortgage is protected. Now, you see, guys, even if you miss a couple mortgage payments because you had a death in the family, you have an illness, or you had an accident, the banks, they will take over your property. You see, we got to realize that even if you take out a mortgage, you do not completely have complete ownership over your home. You can still lose your house if you miss a couple of mortgage payments. And this is why I'm going to be going over why it's so important and how you can protect yourself with the right type of mortgage protection that you can purchase as a homeowner to not only protect your house, but also protect your family and everyone that lives in the house with you. But first, if you haven't met me before, my name is Leon Mann. I'm a licensed wealth consultant with Money Assist Financial. And what I do, I help hardworking folks like you and you add an additional multiple 6 and 7 figures to your retirement portfolio by providing a free, no obligation financial analysis. Basically, it's going to walk you through to see what you need to do in order to map out your dream life and achieve financial independence. Now, what is mortgage protection? Well, mortgage protection is a form of mortgage replacement insurance. And how this works is that you want to make sure that your entire mortgage is covered. Say, for example, right, you have a mortgage of $500,000. You're going to want to have mortgage replacement of $500,000 because if anything happens, like you had a death in the family, you have an illness or an accident, your house can be paid off in its entirety. More importantly, guys, you do not have to sell your house or you do not have to hand your house over to the bank. You want to keep the house within your family. Now, the banks also will provide mortgage protection, but as I'm going to be discussing later, it may not necessarily be in your best interest, but there's two types that you have to be aware of when it comes to mortgage protection. Number one is mortgage protection life insurance. Now, mortgage protection life insurance is a form of life insurance coverage that covers your entire mortgage, for example. So if something happens to one of the homeowners, the death benefit will be able to go to the beneficiary or surviving partner, in which he or she can use to pay off the house in its entirety, right? So you don't have to make any more mortgage payments. This is just one way that you can have peace of mind and secure your house. The other type is mortgage protection disability insurance. What this does, of course, as the name disability suggests, it covers your home in the event of an accident or an illness so that the bills are still going to be paid even if you can't afford to work or you're too sick to get out of your bed, right? The bills are still going to keep coming, but you have to still make the payments. Mortgage protection disability coverage will allow you to still make those all important payments. As I was mentioning earlier, yes, the banks also provide mortgage protection. However, when the banks have mortgage protection, you want to look at it as they will provide you with a sort of group coverage when it comes to mortgage protection. What this means is that if you've ever had group benefits at work, then you know that when that job goes, so does the benefit along with that job. The same thing, guys, applies with the bank. Even if the banks provide you with insurance, if you leave the bank at any time within that ownership of the house, you lose that coverage. And when you apply again, you have to pay even more. It's going to be more costly because you will be a little bit older. And the thing about these type of mortgage replacement is that they increase with age. So it is always a good idea that you want to know what you're being covered for, especially when you go to the banks. The other thing is that every time you refinance your mortgage, the premiums will also go up, right? So I have had horror stories where people purchase mortgage protection, but guess what? The mortgage payments become so large because every time they refinance, the premiums keep on increase. The other thing about purchasing mortgage protection through the banks that you have to be very, very careful about is that they basically will do the underwriting when the claim is being made. Now, in the event that you had an illness at the time of claim, I doubt that you're going to get any death benefit paid out. You see, when you answer the questions at the time of the application, you may not have the conditions that you had when you make the claim. Here is the difference between purchasing mortgage protection through a broker. Number one, with a broker, you will basically have flexibility in terms of how much coverage you want and for how long you want that coverage. Another thing with purchasing mortgage protection through a broker is that if you change your mind, you could always change your coverage. And another thing, if you were to leave your bank, you're still going to be covered. You're covered until the mortgage payment is up when you get covered through a broker. No matter if you decide to leave your bank, you're still covered. Also, if you refinance your house, the premiums, they're not going to go up, but the premiums will remain the same. And also, last but not least, more importantly, the underwriting process, guys, is done at the time of application. What this means is that if you have disclosed any medical issues at the time of application, when you file that claim, you're gonna be paid out the death benefit, right? 99 to 100% of the time, because the underwriting process is done at the time of application. Post underwriting, sorry, not post claim when the claim is being made. Why is this important? Because you're not only covering your home, but you're covering the people that live in the house. You're covering your spouse. If, for example, you can't make the mortgage payments, then your loved ones, your kids, will be forced to also be forced out in the street and find somewhere to live fast, right? Now, here are some tips that you can take to be covered. Number one, you want to look at your financial situation. You want to look at the amount of debt obligations you have. You want to look at your income, and you want to look at your income replacement needs. That is, how long can you survive without the income of your partner? And you want to factor in all of this into your coverage. The second thing is to shop around. Do not settle for just one coverage. There are better options in terms of coverage out there. And that is why I prefer the broker, because a broker, they can shop around to look for the most affordable coverages for you. Thirdly, know your limitations, right? Know what you're getting into. Know how much you're being covered for how long you're being covered for. There is nothing worse than not knowing what you're being covered for, right? So guys, this does conclude my presentation for today. Also, feel free to subscribe. It is free to subscribe. Click on the subscription button and click the bell notifications. Every time I post a new video, you will be the first to notice. Until next time, guys, peace and love. Take care.